It's Wednesday, March 6th. Welcome to Market Foolery. I'm Chris Hill. Joining me in studio today from Fool.com, Austin Smith and Eric Bleeker. Gentlemen, neither rain nor snow, nor sleet nor dark of night, nor terrible drivers in the D.C. area will keep us from our appointed podcast.
I'm just here to see you, Chris.
If you look at the headlines coming out of Washington, D.C., the federal government is shut down because of the snowstorm, but we don't shut down. That's not how we roll.
We are somehow more efficient than the government.
Somehow, some way. We're going to sort of step back from the news of the day a little bit and tackle a few big questions. But we're going to start with something that is very much in the news this week, and that is the Dow hitting a new all-time high. And Austin, I'll just go to you first on this. I suppose it's a matter of perspective. All the headlines are about, the Dow hits a new all-time high. Our colleague Morgan Housel on Twitter this morning put it a different way, which was, another way of looking at this is that the Dow has been flat since October 2007. So Austin Morgan taking a different view there. But when you look at this market and all of the headlines are about the Dow, what is sort of a headline that isn't being reported that you think is key for investors?
I think the interesting thing, at least in what I'm seeing in my sort of casual research, is that there are some really, really smart minds and hedge funders and really incredible investors who've got just phenomenal, 25-year track records. Guys like Ray Dalio, Howard Marks, basically kind of taking opposite sides right now. And it's this market where people, even though we've gone on this great bull run, people are on totally different sides of the fence about whether or not we're basically building up to another bubble or whether or not it's got room to run. Ray Dalio was really, really aggressive at the beginning of this year. Which was a great time to be aggressive.
Sure.
I think the Dow was up 6 or 7% in January. And then we've got Howard Marks basically saying that this is the exact same behavior and attitude that we saw the market doing right before the meltdown, which obviously strikes a bit of fear in people.
Yeah.
So the really interesting thing that I see is that this isn't a high where everybody's on board. There's a lot of people, a lot of really intelligent people on the side saying, whoa, pump the brakes, guys.
Yeah. And we see that with individual stocks, too.
Mm-hmm.
I mean, it's a little bit more dramatic, but you see this with hedge fund managers, taking opposite sides of JCPenney, Herbalife, et cetera. Eric, when you think of the market writ large, what sort of stands out as under the radar, not getting as much attention as the Dow hitting a new all-time high?
Yeah, what kind of stands out is at the time it's doing this, earnings stink. I think in the fourth quarter earnings were up less than 1% year over year. And we saw expectations falling across the entire year. And now we see expectations way too high for this year, and they're going to have to come down. What this actually says is a triumph of kind of long-term investing in a way, because if I had told you at the start of last year corporate earnings were going to be down across the entire year, you probably would have sold the market short with every dollar you owned.
Right.
Yet it's at all-time highs now, so it just kind of reemphasizes the traits of buying really quality companies for the long term.
When you talk about expectations, are there industries that you look at that you think are essentially out of whack? I'm always of two minds when it comes to companies setting expectations. On the one hand, it's good to get guidance. On the other hand, I feel like there are companies, some better than others, that sandbag just so that when earnings time rolls around, that they can we beat our horribly low expectations. Maybe Hewlett-Packard is an example of that. When you look at the fact that it's up somewhere in the neighborhood of 45% just over the last couple of months. But are there any industries in particular that you focus on when it comes to the expectations game?
Well, I think technology is obviously really interesting that people historically just got so used to, these tech companies are so expensive. And now it's becoming one of the cheapest fields in the market. It's the lowest performer of all sectors this entire year. And you do have some companies which can drive really phenomenal growth in the sector, trading at or near single-digit PEs. So that's one field that I found very intriguing. And I think from this point, people could find some really great deals across the next 5 years.
Sticking with technology over the next 5 years, the two biggest tech companies, Austin, Apple and Google. Apple's 15-year run for the stock, if obviously you back out the last 6 months or so, it may be unprecedented, maybe never to be duplicated. When you look at these two companies, which one do you think is going to fare better from the perspective of the stock over the next couple of years?
I'm a happy shareholder of both, but I'm actually going to pick Apple here, even despite the last few months. It's purely a valuation game. They're so incredibly cheap. Their balance sheet has some $140 billion in cash on it right now. It could not be more fortress-like. And Google equally, they have a lot of cash and a great balance sheet, but they're more than twice as expensive. Apple still has a phenomenal cash-generating machine in the form of their tablets and iPhones. Just continue to pump out cash. So they are too cheap now, in my opinion, to not outperform Google in 3 to 5 years.
What about you, Eric?
Yeah, and I think this has become kind of a Wall Street game. On the way up, it's who can have the highest price target, which we're kind of seeing with Google right now.
Yeah.
And with Apple now on the way down, their expectations are too high for the coming quarter. So every analyst is trying to get ahead of the other, lower their targets, move their projections from buy to sell. But then we get into the latter half of the year and comps get easier again. And you realize, oh, this is a phenomenal company trading at a single-digit PE. So, I think they're both great companies, but Google trades about 3 times as expensive right now, and I just think Apple's going to be the better performer from here on out if I had to have that time period.
One thing that I think often gets overlooked about Google or about Apple's cash is that so much of it is overseas.
Mm-hmm.
So when people say, "Oh, they've got $140 billion in cash, why don't they just pay a massive one-time dividend? Why did they do that?" In terms of the cash that they can do something with, that they can allocate here in the U.S., it's actually a much smaller number. How do you think about the cash in particular that they have overseas?
Well, it is I would say it's a overlooked problem, but it's one that the headline is.
It's a nice problem.
The reality is different than the headline, and
My
you're
problem
right.
is I have $90 billion of cash overseas.
Damn.
The Scrooge McDuck issue of investing.
Fortunately, overseas is where a lot of Apple's big growth is going to be. And Eric can definitely speak more to this, but you look at areas like China are just going to be pivotal growth drivers for Apple in years ahead. And if their cash is overseas, they can still meaningfully allocate it, at least in the near term, because that's where their big growth is going to be.
So 2 quick thoughts on this. Number one, Apple still generates about 40% of its cash in the United States. If it paid out 40% of its cash, that's about a 4% dividend yield. I'll take that over a 10-year treasury, paying 2% any day. Second thought on that, repatriation taxes. America gets about $8 billion a year from these taxes. We're the only G7 country that does it. I think a potential catalyst, not just for Apple, but a lot of companies with cash overseas, is that taxation law could be changing in the coming years. So I wouldn't think of that as too hard and fast, because that might be coming down.
Right, and that, like Eric said, that's going to apply to other companies that have hoards overseas, like Cisco, I believe, has an enormous balance overseas. I know Crocs in the retail space kind of suffers from that problem as well.
I was going to say, that seems like one. I mean, not to put too much hope in our national legislators.
We took the day off.
We took the day off because we have snow falling from the sky. But it does seem like there is just a ripe opportunity there for legislation to make it really easy, or certainly much more attractive for companies to bring their cash back to the U.S. And I don't know. I'm not smart enough to know what the solution is there, but it seems like if there was a way to say, hey, we're going to cut that tax by X%, or hey, we're going to have a tax holiday, as many states do, but you got to put some of it to work to hire more people. I don't know. Austin, do you have a thought on that? Or
I mean, I think it's kind of our repatriation tax policy is a bit antiquated, and in my opinion, it sort of seems to be a reaction from the revulsion that people had to outsourcing. There's a lot of people opposed outsourcing, so we're going to make it more difficult for companies to operate there. The point is, companies are going to go where the opportunity is, and there are bigger, faster growing opportunities abroad, so that's where they're going to develop all this cash. And at this point, in my opinion, we don't want to get into the politics of it. It's silly. The cash needs to be easier to bring home, and I think a tax holiday or just rethinking the policy altogether is absolutely essential.
Get to work, Congress. Another battle, and this is not so much about the stock, but certainly for one company, what's been an incredibly lucrative business, and that's sports programming. Fox, or I should say News Corp, made it official. Maybe the worst kept secret in the world of media, but News Corp is launching a Fox Sports network to compete with ESPN. Sports programming, ESPN has been highly profitable for Disney. Eric, when you see a story like this, as we were talking earlier, Disney probably isn't quaking in their boots over this.
Yeah.
But I'm curious what you think about in terms of the economics and in particular the opportunity for News Corp.
Yeah, and thank God for our legal system because they expose all kinds of stuff to us. And in a recent lawsuit with DirecTV, I believe it was, we saw that ESPN has locked in their contracts with about 6.5% uptake rates each year and how much they get paid from cable companies. Shows just how tremendously powerful this company that can lock in those kind of gains for the next 7 years. And I think once you start thinking about that kind of power, you go, it's going to be really hard to disrupt a company like ESPN. Even if Fox has done a great job in things like news, ESPN's a lot better than CNN, I'll say that.
Austin, is the question maybe not so much ESPN versus Fox Sports, but essentially what can Fox Sports do for News Corp? Because sports programming is incredibly lucrative. The licensing fees just keep going up. It's something that where advertising on television fluctuates for different programming. For sports programming, it's been a straight arrow up over the last 30 years or whatever it is. To what extent do you think this move moves the needle in a good way for News Corp?
I actually don't think it does, and it's to Eric's point. Disney is too powerful; they simply have too big a lever to pull here. And although it is sort of like the last great corner of advertising in the TV space, ESPN is just going to continue to dominate. That pricing power is completely unrivaled, and News Corp is going to be in a waiting game, basically trying to develop a mediocre product until something like those contracts expire, and that's 5 to 7 years out, I believe. And even then, they're starting back from zero. ESPN just has such a lead. So what it does for News Corp, I don't think it's meaningful.
When I see competitive log chopping on NBC's sports network, I know how hard it is to get past ESPN because they've bought up almost all the lucrative packages and they often have long-term deals on them.
Hey, I grew up in Maine and I've been to those competitions and it is riveting stuff.
You are their one viewer.
It is riveting stuff.
Tractor Supply loves advertising there.
Next topic, and our producer Matt Greer may have come up with a new brand here. The way he put it, first to die. So 3 companies, you tell me which one you think is going to be the first one to die. Best Buy, Research in Motion, or Barnes & Noble. 3 companies we've talked about extensively on this podcast. And I don't know of anyone who thinks the future is bright for any of these 3 companies. But Eric, I'll go to you first. Which one do you think is closest to the grave?
Yeah, you look at Blackberry and trying to become that third place behind Google and Apple. Good luck. I think, Microsoft's going to be the one that fills that spot a lot better. But I think, that company can at least be acquired. Barnes & Noble, I don't see a lot of people running out to especially buy some of their retail properties. I think that one's probably closest to the grave for me.
Austin?
I'm going to the retail well and going Barnes & Noble as well. Sort of a misperception about Best Buy, although it's not a business I want to own. They actually do produce a fair amount of cash, and they're very, very cheap to right now.
Yeah.
I think they're trading 1.5 to 2 times cash flow. Barnes & Noble doesn't have that same sort of just cash-generating cycle. There's a lot of talk about splitting the company into either their college locations and then their regular stores and then the Nook division, which would basically end Barnes & Noble as we know it. And I think everybody sees it as the only way at least some of the divisions can survive. They're actually relatively more expensive than a lot of these other companies like Best Buy and Research in Motion. They're 6 to 8 times enterprise value to EBITDA. So they've got a bit more ways to fall until they're that cheap. So worst stock to own, I'm going to say Barnes & Noble. First to go under, Barnes & Noble. They don't have a lot of hope.
Barnes & Noble, I have no doubt that maybe if you took their top 30% performing stores, that would be a profitable, much smaller business. But at the same time, I look at these companies, and Barnes & Noble is the one. If you've ever had a friend who's dating someone and they're the only one who thinks that it's a good relationship, and you and all your friends are just like, what are you doing? What are you doing? That's when I look at Barnes & Noble, and I base this almost entirely on my consumer experience at the 2 locations, Best Buy and Barnes & Noble, which are right in the same mall, not too far from Fool HQ. At least in the case of Best Buy, I go in there and there's a sense that they are trying to do something. They're trying to differentiate. They're trying to offer more customer service. And in Barnes & Noble, I just look and go, what are you doing?
Yeah.
What are you trying to do?
I think if you grab the top 3% of Radio Shacks, too, that might be a decent company. But a lot of investors have gone burned, with companies that can't get out of lease agreements and get dragged down not closing stores fast enough.
There's also a certain degree of the tide you just can't swim against here. Even if Barnes & Noble had incredible economics on a per-store basis, we see an increasing number of malls being classified as subpar, which means they're generating less than $300 in sales per square foot. Barnes & Noble, as an anchor of these malls, is really going to hurt when they lock in these long-term lease agreements. They recently renegotiated a lot of them, I believe, in the last 18 months. So they're in these places for a long time.
Right.
And they may have got favorable terms, but the traffic to these malls is increasing dramatically. I think 30% of all malls in the U.S. are now classified as subpar. So even if they have
Wait, is it increasing dramatically or decreasing dramatically?
So Barnes & Noble's, so the number of malls that are classified as subpar is increasing dramatically. Okay. And Barnes & Noble's locked into these places for a long time. So even if they have great economics, if there's no traffic there and you're locked in for 5 to 7 years, it's a bad place to be.
Drop us an email, radio@fool.com. Best Buy, Research in Motion, Barnes & Noble. Which one do you think is going to be the first to die? That's a Matt Greer branded trademark pending, first to die. We'll end on a more positive note, and both you guys focus on emerging technology. I'm curious, is there a company, is there a stock, is there an industry, a space? Certainly, if you get online at fool.com, there's a lot of buzz around 3D printing, but I'm just curious, what's an emerging company or technology that you think investors would do well to keep their eyes on? Eric, I'll start with you.
Oh, I mean, if we're looking at emerging technology, I think one thing people really want to look at, some of the greatest products I'm seeing this year is Sonos system, doing wireless audio throughout the house, lights throughout the house. But the problem that's always been with this is that who wants a washer with its own little controls that you can, operate? What you need was that central platform for it. So I think when you look at smartphones and tablets extending as basically controllers for the whole house and the kind of gains that can provide for an entire system. And who's the biggest tablet player? Apple. So I think there's a kind of thesis hint around this that might start playing out this year and which can also extend to the television. So kind of an under-the-radar re-changing of technology. You
were just looking at a new home the other day, weren't you?
Yeah.
And when you're walking around, did you have that in mind? Like, oh, if I've got my tablet, I'm
drinking the Kool-Aid.
I can control the dishwasher from here.
Oh yeah, I've got my wireless system, looking at the lights that are controlled through the tablet in the house. It's really exciting. And like I said, it used to be there wasn't that central controller for it. Now everything can be controlled with one platform, right? So.
To that point, we've also seen a lot of connected stuff coming out from Whirlpool and Lowe's with their ISIS brand that they're trying to, sort of roll out this idea of an ever-connected but in a cohesive way home. So there's a lot of stuff that's suggesting it's taking off, both from Whirlpool, Lowe's, and I expect Home Depot to follow.
It's exciting stuff, and yet for all of the fights that the television remote control has caused among spouses, I feel like this is just going to ratchet that up. I just feel like, it's like, give me the tablet. No, I want to control the lights.
Well, we're just going to need a tablet for everyone.
Okay, there we go. Austin,
Apple
what about
thesis
you?
Right there. Big tech company I'm looking at, not necessarily a niche industry, but is Zillow. They're a very richly priced stock, but they've got pretty incredible growth behind them. It's a really disruptive idea, and it's still very much in its infancy, but they're doing a lot of things right. Their growth, both on the premium subscriber end, has been tremendous. They're making the responsible shift away from advertising and towards being more reliant on their premium members, which we like to see here at The Fool. So they're a company that's growing gangbusters. They're doing a lot of things right. I really like their management. They're expensive, but it's a company I've had my eye on for a while.
And I don't follow the real estate industry all that closely. What is the competitive threat, to the extent that there is one, for Zillow?
The biggest competitive threat is it's twofold. It's probably Google, if they wanted to knock Zillow off their perch. Now, Zillow and Google recently, got into a little bit of a partnership, but we've seen Google in the past be quick to turn around and crush people when they decide to. So I wouldn't necessarily dismiss that entirely on the base of that relationship. So if Google wanted to come out with their Google Maps and make it a more real estate centric service, they would be a huge threat to Google. And also the brokers. There is a bit of difficulty with Zillow in the fact that they rely on data that's provided to them by brokers and agents, and if those guys feel like they're getting the rough end of the deal here, and there's been a little bit of dissent among the ranks, and they start pulling data from Zillow, keeping it off, that could be a lot of headaches as well. So the two biggest threats, Google and brokers.
We'll end there. Austin Smith, Eric Bleeker. Guys, thanks for being here. As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against, so don't buy or sell stocks based solely on what you hear. That's it for this edition of Market Foolery. Our producer is Matt Greer. I'm Chris Held. Thanks for listening. We'll see you next time.